What is the time value of money?
The time value of money means a dollar today is worth more than a dollar received in the future, because today's dollar can be invested to earn a return. This concept sits underneath present value, future value, bonds, leases, capital budgeting, and plenty of exam mischief.
What is net present value?
Net present value is the present value of expected cash inflows minus the present value of expected cash outflows. A positive NPV generally means the project is expected to add value after considering the required return.
What is the internal rate of return?
Internal rate of return is the discount rate that makes a project's net present value equal zero. It is compared to the hurdle rate to decide whether the project is financially attractive.
What is the payback period?
The payback period measures how long it takes to recover the initial investment from cash inflows. It is easy to compute, but ignores the time value of money and cash flows after payback.
What is the discounted payback period?
Discounted payback is the time needed to recover the initial investment using discounted cash inflows rather than nominal cash inflows. It improves on simple payback by recognizing the time value of money.
What is the profitability index?
The profitability index equals the present value of future cash inflows divided by the initial investment. A value above 1.0 generally indicates a positive NPV project.
What is cost of capital?
Cost of capital is the rate of return a company must earn to satisfy providers of capital and maintain firm value. It is used as a discount rate in capital budgeting and as a benchmark in performance evaluation.
What is the weighted average cost of capital?
Weighted average cost of capital combines the costs of debt, preferred stock, and common equity based on their proportions in the target capital structure. It represents the blended required return for the firm as a whole.
What is CIPM?
The capital asset pricing model estimates the required return on equity as the risk-free rate plus beta times the market risk premium. It links expected return to systematic risk rather than total risk.
What does beta measure?
Beta measures how sensitive a stock's returns are to movements in the overall market. A beta above 1.0 suggests the stock is more volatile than the market, while a beta below 1.0 suggests lower sensitivity.
How do you calculate the after-tax cost of debt?
The after-tax cost of debt equals the before-tax interest rate times 1 minus the tax rate. Because interest is usually tax-deductible, debt financing often has a lower effective cost than equity.
How is the cost of preferred stock generally computed?
The cost of preferred stock is usually the annual preferred dividend divided by the net proceeds from issuance. Since preferred dividends are not tax-deductible, there is no tax shield adjustment like there is with debt.
What is an optimal capital structure?
An optimal capital structure is the mix of debt and equity that minimizes overall cost of capital and maximizes firm value. Too little debt may miss tax benefits, while too much debt increases financial distress risk.
What is operating leverage?
Operating leverage reflects how much fixed operating cost a company has relative to variable cost. Higher operating leverage means profits are more sensitive to changes in sales volume.
What is financial leverage?
Financial leverage arises from using debt or other fixed financing charges. It can magnify returns to owners when results are strong, but it can also magnify losses and default risk when results weaken.
What is combined leverage?
Combined leverage captures the total sensitivity of earnings per share, or net income to changes in sales, by considering both operating leverage and financial leverage together. More leverage means more upside and more drama.
How do you compute break-even units?
Break-even units equal total fixed costs divided by contribution margin per unit. At break-even, total revenue equals total cost and operating income is zero.
What is contribution margin?
Contribution margin is sales minus variable costs. It shows how much revenue remains to cover fixed costs and then generate profit.
What is margin of safety?
Margin of safety is the excess of expected or actual sales over break-even sales. A larger margin of safety means the company has more room before it starts losing money.
What is the relevant range?
The relevant range is the level of activity over which cost behavior assumptions are expected to remain valid. Fixed costs are fixed and variable cost per unit is stable only within that range.
What is the difference between variable and fixed costs?
Variable costs change in total with activity, while fixed costs remain constant in total within the relevant range. Per unit behavior moves in the opposite direction for fixed costs, which is a favorite exam twist.
What is a mixed cost?
A mixed cost includes both fixed and variable components, such as a utility bill with a base charge plus usage charges. Analysts often separate mixed costs to improve budgeting and decision-making.
What is the difference between absorption costing and variable costing?
Absorption costing includes fixed manufacturing overhead in inventory cost, while variable costing treats fixed manufacturing overhead as a period expense. When inventory changes, the two methods can produce different income.
What is activity-based costing?
Activity-based costing assigns overhead based on activities that drive cost consumption rather than broad volume measures alone. It can produce more accurate product or service costs in complex environments.
What is a standard cost system?
A standard cost system uses predetermined cost expectations for materials, labor, and overhead to support planning, control, and variance analysis. Variances then show where actual performance differed from plan.
What is the materials price variance?
The materials price variance measures the effect of paying a different price than expected for the quantity of material purchased or used, depending on the company's approach. It helps isolate purchasing performance from usage efficiency.
What is the materials quantity variance?
The materials quantity variance measures the effect of using more or less material than the standard allows for the actual output achieved. It focuses on efficiency of usage rather than purchase price.
What is the labor rate variance?
The labor rate variance measures the effect of paying a wage rate different from the standard rate for the actual hours worked. Causes may include overtime, skill mix changes, or staffing choices.
What is the labor efficiency variance?
The labor efficiency variance measures the effect of using more or fewer labor hours than the standard allows for actual output. It often reflects training, supervision, scheduling, process quality, or machine issues.
What do variable overhead variances generally measure?
Variable overhead variances generally measure differences in spending rates and efficiency relative to standard. They help determine whether overhead costs changed because of price factors, usage, or both.
What is the fixed overhead volume variance?
The fixed overhead volume variance measures the effect of producing at a level different from the denominator level used to set the fixed overhead application rate. It reflects capacity utilization rather than spending.
What is a static budget?
A static budget is prepared for one plan level of activity and is not adjusted for actual volume. It is useful for planning, but not ideal for evaluating performance when output differs meaningfully from plan.
What is a flexible budget?
A flexible budget adjusts expected revenues and variable costs to the actual level of activity. It provides a fairer basis for performance evaluation because it separates volume effects from operating performance.
What is a rolling forecast?
A rolling forecast is updated continuously by adding a new future period as the current period ends. It helps keep planning current instead of waiting for the next annual budget cycle.
What is sensitivity analysis?
Sensitivity analysis tests how a change in one assumption affects an outcome, holding other assumptions constant. It helps management identify the variables that matter most to risk and value.
What is scenario analysis?
Scenario analysis evaluates outcomes under a coordinated set of assumptions, such as base, best, and worst case. It is broader than single variable sensitivity analysis.
What is the main limitation of what-if modeling?
What-if models are only as good as their assumptions, inputs, and logic. Slick spreadsheets can create very confident nonsense if the underlying drivers are unrealistic.
What is a common size financial statement?
A common size statement expresses each line item as a percentage of a base amount, such as sales on the income statement or total assets on the balance sheet. It helps compare companies of different sizes.
What is horizontal or trend analysis?
Horizontal analysis evaluates changes in amounts or percentages over time. It helps identify growth patterns, unusual swings, and areas requiring investigation.
What is free cash flow?
Free cash flow is the cash available after funding operating needs and capital expenditures. Analysts use it to assess financial flexibility, debt capacity, and valuation.
Why can EBITDA be misleading?
EBITDA excludes interest, taxes, depreciation, and amortization, which can make operating performance easier to compare, but it ignores capital intensity, working capital needs, and real financing burdens. It is a tool, not a truth serum.
What is earnings quality?
Earnings quality refers to how sustainable, repeatable, and cash-supported reported earnings are. High-quality earnings generally come from core operations rather than one-time gains, aggressive estimates, or accounting noise.
What should a CPI candidate remember about non-GAAP measures?
Non-GAAP measures can provide useful supplemental insight, but they should not be misleading, selectively adjusted, or presented more prominently than GAAP results where rules restrict that presentation. Always ask what was excluded and why.
What do liquidity ratios measure?
Liquidity ratios measure a company's ability to meet short-term obligations as they come due. Common examples include the current ratio and quick ratio.
How does paying a current liability with cash affect the current ratio when the ratio is above 1?
If the current ratio is above 1, using cash to pay a current liability generally increases the current ratio because both numerator and denominator fall, but the denominator falls proportionally more. This is a beloved directional analysis question.
What is the quick ratio?
The quick ratio equals quick assets divided by current liabilities, where quick assets usually include cash, marketable securities, and receivables. It is more conservative than the current ratio because it excludes inventory and other less liquid current assets.
Why is working capital management important?
Working capital management affects liquidity, operating efficiency, financing needs, and profitability. Too little working capital strains operations, while too much can trap cash in low-return assets.
What is the cash conversion cycle?
The cash conversion cycle measures the time between paying for inventory and collecting cash from customers. It is commonly calculated as days inventory, outstanding plus days sales, outstanding minus days payables outstanding.
What does inventory turnover tell you?
Inventory turnover measures how quickly inventory is sold relative to its average balance. Higher turnover can signal efficiency, but an extremely high rate may also indicate stockouts or insufficient inventory levels.
What does receivables turnover or days sales outstanding indicate?
Receivables turnover and days sales outstanding indicate how quickly a company collects credit sales. Slower collections may signal weaker credit policy, customer stress, or issues in billing and collections.
What is the trade-off in stretching payables?
Delaying vendor payments can improve short-term cash flow, but it may damage supplier relationships, cause lost discounts, or signal liquidity stress. Good working capital management is not just about squeezing the calendar.
What is the interest coverage ratio?
Interest coverage measures a firm's ability to cover interest expense from operating earnings, often using EBIT or EBITDA depending on context. Higher coverage generally means lower default risk.
What is the debt service coverage ratio?
Debt service coverage compares available cash flow to required principal and interest payments. Lenders watch it closely because surviving on optimism is not considered a repayment strategy.
What is DuPont analysis?
DuPont analysis breaks return on equity into profit margin, asset turnover, and financial leverage. It helps identify whether ROE is driven by operations, efficiency, or leverage.
What is the difference between return on assets and return on equity?
Return on assets measures profitability relative to all assets employed, while return on equity measures profitability relative to owner's equity. ROE is typically more sensitive to leverage.
What is economic value added?
Economic value added measures whether a company generated operating profit above the cost of capital employed. A positive EVI suggests value creation rather than merely accounting profit.
What is discounted cash flow valuation?
Discounted cash flow valuation estimates value by forecasting future cash flows and discounting them at an appropriate required return. It is conceptually powerful but highly sensitive to assumptions.
Why is terminal value important in DCF analysis?
Terminal value captures the value of cash flows beyond the explicit forecast period and often makes up a large portion of total estimated value. That means tiny assumption changes can have giant effects.
What is comparable company analysis?
Comparable company analysis estimates value using market multiples from similar publicly traded companies. Its usefulness depends on choosing truly comparable peers and understanding differences in growth, risk, and margin.
What are precedent transactions?
Precedent transactions use pricing multiples from actual acquisitions of similar companies to estimate value. These multiples often include control premiums, so they may exceed public trading multiples.
What is the difference between book value and market value?
Book value reflects recorded accounting amounts, while market value reflects what investors are currently willing to pay. The gap can be large because accounting statements are not built to measure real-time market sentiment.
What is the law of demand?
The law of demand states that, all else equal, quantity demanded tends to fall when price rises and rise when price falls. It reflects consumer substitution and purchasing behavior.
What is the law of supply?
The law of supply states that, all else equal, quantity supplied tends to rise when price rises and fall when price falls. Higher prices create greater incentive for producers to supply goods or services.
What is price elasticity of demand?
Price elasticity of demand measures how sensitive quantity demanded is to a change in price. Demand is more elastic when customers have substitutes or the purchase is easier to delay.
What is cross-price elasticity?
Cross-price elasticity measures how the demand for one good changes when the price of another good changes. Positive cross-elasticity often indicates substitute goods, while negative values often indicate complementary goods.
What is income elasticity of demand?
Income elasticity measures how demand changes as consumer income changes. It helps distinguish normal goods from inferior goods and supports forecasting in changing economic conditions.
What is a price ceiling?
A price ceiling is a legal maximum price. If set below market equilibrium, it can create shortages because quantity demanded exceeds quantity supplied.
What is a price floor?
A price floor is a legal minimum price. If set above market equilibrium, it can create surpluses because quantity supplied exceeds quantity demanded.
What is perfect competition?
Perfect competition is a market structure with many buyers and sellers, homogeneous products, free entry and exit, and no single participant able to influence price. It is mainly a benchmark model rather than everyday reality.
What is a monopoly?
A monopoly exists when one seller dominates the market with substantial barriers to entry. Monopolies have pricing power, but they may also face regulation and public scrutiny.
What is monopolistic competition?
Monopolistic competition features many sellers offering differentiated products. Firms have some pricing power, but competition remains active because substitutes still exist.
What is an oligopoly?
An oligopoly is a market dominated by a small number of large firms whose decisions affect one another. Pricing, output, and strategy are often interdependent.
What is gross domestic product?
Gross domestic product is the total market value of final goods and services produced within a country's borders during a period. It is a primary measure of economic output.
What is inflation?
Inflation is a sustained increase in the general price level over time, which reduces purchasing power. Moderate inflation may be manageable, but high or volatile inflation complicates planning, valuation, and financing.
What is the difference between CPI and the GDP deflator?
The Consumer Price Index tracks prices of a basket of consumer goods and services, while the GDP deflator reflects prices of domestically produced final goods and services in the economy. They measure inflation differently because their baskets and coverage differ.
What are the main types of unemployment?
Common types include frictional unemployment from normal job transitions, structural unemployment from skill or industry mismatch, and cyclical unemployment tied to economic downturns. The type helps explain the likely policy response.
What is fiscal policy?
Fiscal policy uses government spending and taxation to influence the economy. Expansionary fiscal policy tends to stimulate demand, while contractionary policy tends to cool it.
What is monetary policy?
Monetary policy uses central bank tools such as interest rates and money supply management to influence inflation, employment, and economic activity. Lower rates generally encourage borrowing and spending, while higher rates do the opposite.
What is the relationship between bond prices and interest rates?
Bond prices and market interest rates generally move in opposite directions. When rates rise, existing bonds with lower coupons become less attractive and their prices fall.
What does the yield curve show?
The yield curve shows interest rates across bonds of different maturities at a point in time. Its shape can signal market expectations about growth, inflation, and recession risk.
What is foreign exchange transaction exposure?
Transaction exposure is the risk that exchange rate changes will affect the value of specific foreign currency denominated receivables, payables, or commitments before settlement. It directly affects realized cash flows.
What is foreign exchange translation exposure?
Translation exposure is the accounting risk that exchange rate changes will affect the reported amounts of foreign subsidiaries when their financial statements are translated into the reporting currency. It may affect reported equity and income presentation even when cash has not moved.
What is economic exposure?
Economic exposure is the broader risk that exchange rate changes alter a company's long-term competitive position, costs, pricing power, and future cash flows. It is wider and more strategic than transaction exposure.
Why do companies hedge?
Companies hedge to reduce unwanted volatility in cash flows, earnings, or asset values caused by interest rates, foreign exchange, commodity prices, or other market factors. Hedging aims to manage risk, not to turn treasury into a casino.
What is country risk?
Country risk is the risk that political, economic, legal, or social conditions in a country will impair business operations or returns. It includes expropriation risk, currency controls, instability, and regulatory uncertainty.
What is the business objective of transfer pricing?
Transfer pricing sets prices for transactions between related entities and affects reported profitability, tax positions, and performance measurement across jurisdictions. It must be economically supportable and compliant with tax rules.
What are the 5 components of COSO ERM?
The updated COSO ERM framework is often summarized as governance and culture, strategy and objective setting, performance, review and revision, and information, communication, and reporting. It links risk management directly to strategy rather than treating risk as a side activity.
What is the difference between risk appetite and risk tolerance?
Risk appetite is the broad amount and type of risk an organization is willing to accept in pursuit of value, while risk tolerance is the acceptable variation around specific objectives. Appetite is the big picture. Tolerance is the measurable guardrail.
What is the difference between inherent risk and residual risk?
Inherent risk is the level of risk before considering controls or responses, while residual risk is the remaining risk after those controls or responses are applied. Management wants residual risk to fit within tolerance.
Why are ESG metrics relevant in business analysis?
Environmental, social, and governance metrics can affect financing costs, regulatory exposure, reputation, supply chain resilience, and investor demand. Even when disclosure frameworks vary, the business impacts can be real.
How can sustainability-linked finance affect risk analysis?
Sustainability-linked loans or targets can change borrowing costs, performance incentives, and reporting demands. Analysts should consider whether targets are credible, measurable, and operationally realistic.
Why is the fraud triangle relevant in business analysis?
The fraud triangle highlights pressure, opportunity, and rationalization as conditions that can increase fraud risk. Analysts should be more skeptical when incentives, weak controls, or financial strain are present.
What is a make or buy decision?
A make or buy decision compares relevant costs and strategic considerations of producing internally versus outsourcing. Only costs and benefits that change because of the decision should matter.
How should a special order be evaluated?
A special order should be evaluated based on relevant incremental revenue, incremental cost, capacity availability, and strategic side effects such as pricing expectations or channel conflict. Allocated fixed costs often muddy the water but may not be relevant.
What is a bottleneck or constrained resource?
A bottleneck is the limited resource that restricts total output, such as machine hours or skilled labor time. When capacity is constrained, managers should prioritize products with the highest contribution margin per unit of the scarce resource.
How are joint product decisions evaluated after the split-off point?
After split-off, further processing decisions should compare incremental revenue from additional processing to the incremental processing cost. Joint costs incurred before split-off are sunk for that decision.
What is a sunk cost?
A sunk cost is a past cost that cannot be changed by the current decision. It should be ignored in relevant cost analysis, no matter how emotionally attached management feels to it.
What is an opportunity cost?
Opportunity cost is the benefit foregone by choosing one option instead of the next best alternative. It matters in business decisions even though it may not appear directly in the accounting records.
How are expected value and decision trees used in business analysis?
Expected value combines outcomes with their probabilities to estimate the average result of uncertain choices, and decision trees organize those possible paths visually. They are especially useful when management must compare risk across multiple scenarios.
What should a CPI candidate remember about the normal distribution and hypothesis testing?
In a normal distribution, many observations cluster near the mean and fewer appear in the tails, which supports common probability judgments and confidence intervals. In hypothesis testing, the p-value helps evaluate whether the observed result is unlikely under the null hypothesis, but statistical significance is not automatically business significance.